gentlemen, thank you for standing by, and welcome to Itamar Medical First Quarter 2021 Earnings Conference Call. At this time, all participants are on a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press the star then the 1 key on your touch-tone telephone. Please be advised that today's conference may be recorded. If you require operator assistance, please press star then 0. I would now like to turn the conference over to your speaker host, Lee Salvo of Investor Relations. Please go ahead.
Thank you, and thank you all for participating in today's call. Earlier today, Itamar Medical released financial results for the quarter ended March 31st, 2021. A copy of the press release is available on the company's website. Before we begin, I would like to remind everyone that during this conference call, Itamar will make certain statements that are considered forward-looking within the meaning of the Private Securities Litigation Reform Act of 1995. These forward-looking statements generally relate to the company's plans, objectives, and expectations for future operations and are based on management's current estimates and projections for future results or trends. Because such statements deal with future events, they are subject to various risks and uncertainties, assumptions, and actual results expressed or implied by such forward-looking statements could differ materially from Itamar's current expectations. Factors that could cause or contribute to such differences include risks, uncertainties, and assumptions discussed from time to time by Itamar in reports filed with or furnished to the SEC, including the latest annual report on Form 20-F. Except as otherwise required by law, Itamar undertakes no obligation to publicly release any revisions to these forward-looking statements to reflect events or circumstances after the date hereof or to reflect the occurrence of unanticipated events. During this call, statements may include, in addition to financial results prepared in accordance with IFRS, as issued by the IASB, also measures as defined by non-IFRS financial measures for operating loss and net loss, which are adjusted from results based on IFRS to exclude 1. Share-based payments, 2. Depreciation and amortization of property and equipment and intangible assets, 3. Change in provision for doubtful and bad debt, and 4. Non-recurring expenses related to relocating our production facilities to a new location. Management believes that non-IFRS financial measures provided in our earnings press release are useful to investors' understanding and assessment of the company's performance. Management uses both IFRS and non-IFRS measures when operating and evaluating the company's business internally and therefore decided to make these non-IFRS adjustments available to investors. The presentation of this non-IFRS financial information is not intended to be considered in isolation or as a substitute for the financial information prepared and presented in accordance with IFRS. For further details, the reconciliation of operating loss and net loss on an IFRS basis to a non-IFRS basis is provided in our earnings press release issued earlier today. And with that, I'll turn the call over to Gilad Glick, CEO.
Thank you, Lee. Good afternoon, everyone, and thank you for joining us for our first quarter 2021 conference call. I'm joined on the call today by Shai Basson, our CFO. Our first quarter was marked by strong top-line performance, continued operational execution, and progress across each of our long-term growth drivers. We were pleased to see the momentum from the latter half of 2020 continued into the first quarter, enabling us to achieve record first quarter revenue of $12 million, representing a 43% year-over-year increase. Drilling down into the first quarter results a bit more. Demand for WatchPad increased throughout the US, Europe, and Japan despite continued impact from COVID restrictions, particularly in the earlier part of the quarter. Our US core sleep business was once again the primary growth driver as home-based care continued to drive adoption. Our WatchPad 1 single-use and smartphone connected test continued to drive practice workflow changes permanently, and we saw tests from our cardiology segment reach an all-time high. WatchPad revenues in the US increased 38% year over year, driven primarily by WatchPad 1 and WatchPad Direct. Total WatchBot revenues increased by 33% year over year. Our non-IFRS gross margin was approximately 72%, a sequential improvement over the fourth quarter and in line with our expectations. Our continued gross margin improvement is largely due to the implementation of further cost reductions in design and production, mainly on the WatchBot 1. On that front, we are happy to share that in April, we commenced operations in our brand new state-of-the-art 15,000 square foot production facility in Caesarea, which provides an additional layer of support towards our goal of approaching non-IFRS gross margins of approximately 75% by year-end 2021. Overall, demand for WatchBot is increasing worldwide. Even as COVID restrictions began lifting, sales remain strong. In the recent third-party survey we conducted to determine the current dynamics of the sleep apnea diagnostic market, results showed that home-based testing was considered an appropriate alternative to PSG testing performed in sleep labs. Encouragingly, most clinicians surveyed indicated their belief that the recent shift from PSG to HSAT is here to stay even after the pandemic is under control. Turning to our long-term growth drivers, we've continued to make notable progress in the core sleep, cardiology, and international expansion segments. We have a number of new exciting catalysts on the horizon, and importantly, have a significantly strengthened balance sheet in place to support strategic initiatives designed to leverage these catalysts following the closing of a $50 million public offering earlier this year. In core sleep, WatchBot 1 was once again our most significant growth driver, with 725 customers ordering the product by the end of the first quarter, up from 628 at year-end 2020. Importantly, we have seen a significant increase in WatchBot 1 utilization over the past couple of months compared to earlier in the year, as more patients emerge from diagnosis and treatment as pandemic restrictions were lifted. In the first quarter, we added 97 new WatchBot 1 customers, with 60 of those being new to Itamar, not just WatchBot 1 technology. We had an average of approximately 32 new customers onboarded per month throughout the first quarter and remain very encouraged by the ramp-up in market share we are gaining as we further expand into the approximately 2,000 sleep centers in the U.S. Turning to our cardiology market, sales in the U.S. continued a fast recovery from COVID slowdown and saw a quarterly record high of HSAT tests, demonstrating 18% growth compared to the first quarter of 2020. Turning to commercial traction, we continue to invest in increasing U.S. penetration and expanding into new territories and verticals, ending the March quarter with 37 territories and verticals, compared to 33 at the end of 2020 and 32 at the end of the first quarter of the prior year. We are tracking our goal of 43 territories and verticals by year-end 2021 and expect sales in the U.S. grow approximately 30% to 40% throughout 2021. Outside the U.S., we saw strength emerging in Europe, which reached a new high of WatchBot revenue contribution in the first quarter as physicians have started to adopt WatchBot 1 and were likely working through a backlog of pent-up demand. We also continue to see increasing opportunity emerging in Scandinavian countries, Australia, France, and the United Arab Emirates. In Japan, we received and recognized a large WatchBot order in the first quarter of approximately $1.4 million. While we were pleased to see the commitment and potential for expansion in this region, we do not expect order of this magnitude in Japan for the remainder of 2021. Overall, we believe international sales can be meaningful growth driver for us. However, we are cautious in our expectations over the next several quarters as COVID variants spike and many restrictions remain or have been reintroduced. Now, turning to innovation and our development pipeline. As many of you know, in January, we acquired the assets of Spry Health, a San Francisco-based developer of an FDA-cleared, wrist-based medical-grade remote patient monitoring or RPM solution. We are making good progress on the development of an enhanced device that will combine our WatchPad technology and Spry Loop technology to bring to market the first device for continuous RPM of sleep apnea. We are also preparing to launch 3 additions to our WatchPad product line at Sleep 2021, a joint meeting of the American Academy of Sleep Medicine and the Sleep Research Society. The first product is an expansion of our WatchPad 1 Sleep Path dashboard that will include subjective data collected from the patient through a smartphone app before and after the home sleep test. This can provide a physician with more granular information that looks further than an apnea-hypopnea index, or AHI, as index used to indicate the severity of sleep apnea, such as the assessment of insomnia. This and other benefits of instant access will now also be available in our reusable WatchPad 300 through the WatchPad Connect adapter. In addition, we expect to launch a version of WatchPad 1 Multi-Night targeting to address recent demand for monitoring night-to-night variability. We look forward to updating you on these launches once the rollout is underway. Turning to our outlook for the rest of the year, we did experience some pandemic-related headwinds in the first quarter, such as a worldwide shortage of nitrile membranes, prolonged onboarding of field personnel, and increased shipment costs, among other factors that may have further impact on our business in the next few quarters. However, with further declines in COVID cases in the U.S. and an ever-increasing population of individuals getting vaccinated, we now see improved visibility in our business and our ability to meet the growing demand for the diagnosis and management of respiratory sleep disorder. As a result, while our second quarter may see some pullback, as I noted earlier, we do expect to see a heavier lift in the second half of the year due to the timing of budget-related spending in various countries. As we look out towards 2021 and beyond, we remain focused on the same priorities that have driven our success thus far. These include, first, continued initiatives expected to drive market share, both in the U.S. and globally, by driving further productivity of our direct sales force, successful onboarding of new customers, and development of new markets in Europe and Asia. We also plan to drive new features and capabilities of our existing WatchPad product family, and now including advancing the Loop technology we acquired from Spry towards commercialization. And lastly, we expect to continue to identify and pursue additional inorganic growth opportunities. And with that, I'd like to turn the call over to Shai Basson, our CFO, for more detailed review of our first quarter 2021 financial results and guidance. Shai?
Thank you, Gilad. Revenue for the first 3 months ended March 31st, 2021 was $12 million, a 43% increase from $8.4 million in the same period of the prior year. Growth was again mainly driven by the increase in WatchPad sales in the US and the increase in Japan and Europe. WatchPad revenue was $10.9 million, an increase of 33% compared to the first quarter of 2020. US WatchPad revenue was $8.4 million compared to $6.1 million in the first quarter of 2020, reflecting a 38% increase driven primarily by WatchPad 1 as well as WatchPad Direct sales. Sales from disposable and renewable products, including WatchPad 1, comprise approximately 79% of WatchPat revenue in the U.S. compared to approximately 75% in the first quarter of 2020. Turning our attention to the rest of the P&L for the first quarter of 2021, IFRS gross margin was 67% compared to 69% in the fourth quarter of 2020. Non-IFRS gross margin increased to 72% compared to 71% on the fourth quarter of 2020. Non-IFRS gross margin improvement was mainly attributed to the continuing decrease in WatchPat 1 production cost. IFRS operating loss for the first quarter was $5.3 million compared to $2 million in the same quarter of the prior year. IFRS operating expenses include $1.1 million relating to non-recurring stock-based compensation expenses resulting from the extension of the exercise period of vested service option terms from 5 to 10 years. Non-IFRS operating loss for the first quarter of 2021 was $2.8 million compared to $1.4 million in the same quarter of the prior year. The increase in non-IFRS operating expenses was primarily attributed to the following factors. Selling and marketing expenses associated with the expansion of the U.S. sales team into new territories and verticals, and an increase in consulting fees relating to reimbursement in the U.S., Australia, and Japan. An increase of approximately $500,000 in R&D expenses associated with the Spry technology development, and an increase in personnel to support product development mainly related to our digital health platform, and general and administrative expenses mainly associated with an increase in directors and officers insurance premiums, as well as an increase in legal expenses, including a commercial dispute in defense of our intellectual property initiated by us. Net loss for the quarter was $5.5 million compared to $2 million in the same period of the prior year. Non-IFRS net loss was $3 million compared to $1.4 million in the same quarter of the prior year. Non-IFRS loss per ADS was 20 cents compared to 11 cents in the same quarter of 2020. As of March 31st, 2021, we had cash and cash equivalents and short-term bank deposits of $78.9 million. This includes net proceeds of $46.7 million from our public offering in February 2021. Turning to our outlook for 2021, we continue to expect full-year revenue in the range of $52 million to $53 million, representing growth of 27% to 29% over 2020 revenue. As we look out towards the remainder of the year, our company is emerging from the pandemic with a strength and momentum. We are optimistic we can soon overcome the remaining challenges that Gilad noted earlier and continue to focus on multiple catalysts we have in sight and to increasing the long-term shareholder value of Itamar. With that, we will now open the line up to questions. Operator?
Thank you. Ladies and gentlemen, to ask a question on the phone lines, you will need to press the star then the 1 key on your touchtone telephone. To withdraw your question, press the pound key. Please stand by while we compile the Q&A roster. Now, question coming from the line of Matthew O'Brien with Piper Sandler. Your line is open.
Good afternoon. Thanks for taking that question, gents. I guess maybe, Gilad, for starters, on these headwinds that you mentioned, coming out, from a material perspective and then also onboarding, can you just talk about the level of those headwinds? Are they, it sounds like they're going to linger here in Q2 a little bit. Just talk a little bit about, about the magnitude of those headwinds and then moving through that into the back half of the year.
Right. First, thank you very much, Matt, for joining us. Appreciate very much. The headwinds we describe are not Itamar specific. They're broader in the electronic industry in general. I think most of you are familiar from many other companies. There is no impact to Itamar right now, but it's something we need to manage. Means we probably have to increase our long lead item inventory because supply is not as predictable as it used to be. Stuff like this, shipping now, there is some increase in prices and world shortage in capacity. Again, with the volumes of our devices and the weight of our devices, it's not impacting us directly, but it's something we have to manage. That takes some more planning, takes some more, electing few vendors just to make sure we always have access to capacity. But none of them have actual impact on our company right now or something we can predict. But we have to be cautious about those global trends and recognize them.
Okay, that's helpful. I guess what I'm really getting to as part of that question is, you left the guidance unchanged. You just put up a really strong Q1. You're now guiding to kind of things pulling back here a little bit in Q2. I guess the Japan order and everything. But, if you just annualize what you're doing here and put a little bit of growth on that, you're getting to that guidance range pretty quickly. So is it really that factor, just, worried about some of the supply issues and the COVID issues just globally that are keeping the guidance range kind of where it is right now?
Yes, we are. The most important element is we still believe that the pandemic, definitely in Europe, in Tokyo, as we heard, and in some areas in the U.S., is still not under full control. While here, where we sit in Israel, it's, really, most of the population is vaccinated. That's not the situation worldwide. So we remain cautious. That's the first element. Second element, as Shai will indicate later on, Japan, big order, and the modest growth we expect from Japan year over year before we solve the AHI criteria problem is another factor we have to consider. And typically we're cautious with our guidance unless we have very strong indicator and high confidence that we can do something different. We remain on the safe side.
Okay, and then last question for me is just on, you're still onboarding a ton of new accounts, which is great to see, and new customers. What have you seen from some folks that you are maybe adding kind of middle of last year as the pandemic was really breaking out? Have those customers stayed with you? Are they still growing with you? Or, are they starting to shift a little bit away to more of the traditional, PSG testing? Are you getting any hints of that? Or is this, as you mentioned earlier from your survey, you're feeling good that it's a very durable new customer base going forward? They're going to keep using a lot more WatchPat 1 in the future.
Yeah, definitely the latter. We're monitoring our numbers per customers, per region, repeat orders, and what we've seen is that the WatchPat 300 business came back to its pre-COVID level, while the entire WatchPat 1 business is incremental. Most of the customers that we onboarded remain in a reorder patterns. They're loyal to the product. Although, as you mentioned, there is some relaxation around the access to healthcare facilities. It looks across the U.S. in literally vast majority of our territories, we see the same behavior, and that's very encouraging for us.
Absolutely. Thank you so much.
Thank you, sir.
And our next question coming from the line of Josh Jennings with Cowen. Your line is open.
Hi, good morning, Gilad and Shai. Thanks for taking the questions. I wanted to ask, it's great to see that the momentum continuing here into 2021. The new customer adds still very strong. I was hoping to just get a little bit more detail on the new customer adds as we're now in the Q1 and into Q2. And just the mix that you're seeing from them. Are these new customers, as they onboard, moving directly to WatchPat 1, as most new customers were, during the eye of the storm of the pandemic last year, and And maybe you could share just some details or high-level color on just the mix of WatchPat 1, WatchPat Direct, and WatchPat 300 within the new customers that have been onboarded in 2021 so far.
Shai, you want to take this question?
Yeah. So the number of questions, first of all, Josh, thank you for participating and taking the call. Highly appreciated. The number that we are disclosing is the number of WatchPat 1 customers. It's a combination of existing customers and new customers that are joining Itamar. It's a blend. I would say that roughly 2/3 are new to Itamar, and about 1/3 are customers that are already within Itamar that are being utilizing the WatchPat 1 on top or in parallel to their multi-use, the WatchPat 300. The blend from a size of customers is, I would say, all the variation. You could see, single physicians, whether sleep or dental or others, to large corporations, the VA, a lot of facilities, and the Kaiser of the world. And last, I would say, and we've indicated in the script, is that we have seen a large increase in utilization in the month of March and April compared to the months that we had earlier this year, January and February, and this is where we are getting our encouragements also towards Q2 as we entered or in the middle of Q2. So we're seeing increase in utilization. Actually, our customers using the WatchPat 1s. Last, I would say about WatchPat Direct. WatchPat Direct grew to a very significant portion. We are conducting roughly, I would say, more than 3,000 tests a month on WatchPat Direct. And WatchPat Direct, we are conducting it, I would say, it's basically a blend of 50% of the WatchPat Direct. We are shipping our multi-use devices, and 50% we are shipping our WatchPat 1 devices. And the segment is growing, is the fastest growing segment with WatchPat 1 at Itamar Medical.
Thanks for those details, Shai. And a follow-up on, I wanted to try and, just on the cardiology channel, I wanted to try and understand kind of where you sit today. I mean, our view or our understanding was that the pandemic really opened up the core sleep channel more fully. That was taking up a lot of the time for the sales force, and it seems like that's probably continued with the surges through the end of last year and the beginning of this year. But just was hoping for a status update on where you feel Itamar is positioned in the cardiology channel. How early it is, and is it right to kind of think about the cardiology channel? Is it still very, very early innings for Itamar, and with this layer of growth coming on as we move through 2021, but even more so in 2022 and 2023?
Yeah, Josh, this is a great question. What we've seen is exactly what you described. We've seen the cardiology tests in the last few months reaching all-time high, and we reported it, significant all-time high, not just a little bit all-time high. I'm talking double digits in percentage versus everything we've seen before. Cardiology offices are opened. Definitely, I think some of the discussions around post-COVID cardiovascular complications, if you will, or post-COVID-19 cardiovascular stress is very present in the cardiovascular circles, and sleep apnea is a risk factor that actually mechanically impose more stress on the heart. Both mechanical stress as well as electrical stress is definitely in the awareness of the doctors. We've conducted multiple webinars, advisory boards. They're fully attended. We see new offices opened up. And again, the most important, we see number of cardiology tests surging in the last few months, with April being really by far an all-time high for us.
Great. And maybe just one last question. You commented on the pipeline and some products you'll be introducing at the sleep conference coming up here in a couple of weeks. You talk about multi-night version of WatchPat 1. I was hoping to just get some more color on that. And this sounds like multi-night monitoring to determine night-to-night variability in certain indexes or metrics. Maybe talk about pricing, just any other details you can share, pricing, how this will fit into the portfolio and how it will be used in the sleep channel. Thanks a lot.
Yes, no, thank you, Josh, very much. So yes, we've invested since the beginning of the pandemic in a host of line extensions to the WatchBot products that we've realized this is a response to what we've seen in the market. So for example, I would say in order of priority, the most exciting product we're going to launch is Sleep, is turning the app on the smartphone from WatchBot 1 that so far have been a passive transmitter of data back to the cloud and the backend into a active communication tool with the patients based on public, kind of popular demand from the sleep doctors to survey the patients around their subjective situation prior to taking the test. Have they consumed alcohol? How they slept the last night? Have they taken a nap? And how they feel the morning after, if there is a presence of insomnia, for example. That's something we can survey, which is validated questionnaire in an interactive, graphically easy-to-use fashion that today is being done by shipping a bunch of papers to the patients or asking them to come fill it in the clinic, which it's not possible. And then integrating all those questions directly and automatically in a graphic fashion into the sleep report. This is really exciting. This is one example. Another example is to enabling, to your point, multi-night variability, but it stems from the WatchBot 1 understanding. For example, so far in the world of sleep, you've given a device to a patient, it was returned after a week or two, then it takes a week or two to look at the results. With WatchBot 1, the results are available the morning of, 5 minutes after the patient wakes up. Practically, if there is questions about a follow-up night, a doctor can ask the patient to conduct a second night test. For example, while sleeping on their back or sleeping on their side. Something that was not possible until now, not in PSG nor at home. So this is a whole development. We call it, kind of look beyond AHI about how our technology, in particular WatchBot 1 technology that was developed and became popular in the last 18 months, is enabling new innovation that was not even possible to think of 18 months ago.
Oh, that's great to hear. Thanks a lot.
Thank you.
Now, next question coming from the line of Richard Neuwirth with SVB Leerink. Your line is open.
Hi, thanks for taking the question, guys.
Hey, Rich.
So wanted to just start off with the comments around the second quarter, and make sure I'm understanding. So, Gilad, you're not seeing any impact from the supply considerations that you described as of yet, and you're basically just calling out some caution just in case. I guess we're halfway through, or more than halfway through the second quarter. Has there been any sign at all? And were your comments specific that there was no impact to the first quarter, but you're starting to see some in the second quarter, or you haven't seen anything in the first quarter or second quarter to date? And this is all just to to be cautious because you do think and be prepared for any disruption that may occur. And my second question to that is, if it's still out in front, I guess what gives you confidence that would be a second quarter issue only, and that it would bounce back or self-correct by the back half? Thanks.
No, great question, Rich. Thank you again. Thank you for calling into the call today. No impact whatsoever as of now on the company. Zero. Just to be very, very clear, we have not had any supply challenges at all, and we don't anticipate any supply challenges that we can think of. What we've done, though, we're recognizing those global trends. We're hearing about them from our sub-suppliers and from our board, which sits on many other companies that are technology, high-tech, mostly in those kind of industries. So what we've done, and we want to reassure the street that we've taken appropriate actions to what we could to in advance and proactively mitigate those risks by buying bigger inventory of long lead items, for example. That impact our inventory on the balance sheet. You will see, actually you can see it on our report, our balance sheet on inventory have grown sizably, but that's in response to those kind of risks. But no actual or something we can see that will impact Q1 or Q2 or any future quarters, as far as we can tell.
Okay, I guess that helps on the balance sheet dynamic, but just from a revenue and a top line standpoint, I'm just trying to make sure that there's no change in underlying demand, and if the supply issues are things that you're getting ahead of, to Matt's question earlier, just the guidance would seem to imply some conservatism, which is okay. It's early in the year, but is that what we're looking at? Just some conservatism on the top line, and you're expecting relatively minimal top line impact and an ability to satisfy all demand if it materializes?
Yeah, as far as we can see now, no impact on top line whatsoever. 100% of the conservatism in the top line is to do with market conditions, in particular COVID. That's the one we're worried about, and stay conservative because it's, in our view, is not 100% under control. We do not anticipate any impact on top line because of supply issues whatsoever. Really, I really could not stress it enough. We're just again recognizing those potential challenges and telling the street we're mitigating them, and the price we pay is a little bit thicker balance sheet item on the inventory level.
Helpful. One more, if I could, just the. You've given some outlooks. I know you mentioned in reference to surveys. You've given your outlook on where you think the HSA portion of the market is going to be headed and where we are now relative to in-lab. I'm just curious if you could share kind of what the share is of HSA today and any changes to kind of where you think that settles out now that we are starting to, in fact, actually be on the other side of the pandemic. Thanks.
Right. Yes. So we have obviously we have the 2019 numbers. Our share was 24.5 rough numbers %. Given all the growth we've seen and what we've surveyed the market, we estimate, just to be very clear, we don't know the share yet because claims data has not been reported for 2020. That's coming in July, August timeframe. But from all the triangulation we did, we estimating our share have increased in the HST space to, again, this is a rough estimate, to maybe 10, 15 points more than that, so 35 to 40% market share. We can be wrong here, so when the numbers will come, we'll report them, but that's our best estimate right now. We see no change in our broad customer base when it comes to in-lab PSG versus HST. Those that converted stay with HST. Those that open new HST programs remain with them. We have not seen increase in PSG activities in the last few months, as far as our customers can tell us. So we think that our market share gain is still holding. We still believe that in 2020 was a decrease in the overall HST market, right? We reported that maybe 200, 300,000 tests less because the overall impact. So our share is built from growing our business and a little bit shrinkage of the overall market, but that's kind of the numbers. None of them is validated, so please use it with caution. Cannot stress it enough.
Okay, but you still feel like 50-50 is the right way to think of the mix looking forward?
Yes, I believe that as long as PSG reimbursement is still that lucrative and CMS will not revise PSG reimbursement down, it probably will remain in the 50-50 range because of economic reasons.
Okay, thank you.
Thank you, Rich.
Our next question coming from the line of Jeffrey Cohen with Ladenburg Thalmann. Your line is open.
Gilad and Shai, how are you?
Hey, Jeff, thank you for calling very much.
So,
hey, Jeff.
How are you? So, could you talk about the U.S. commercial team and your commentary going to 43? Does that increase somewhat linearly throughout the year? And are you seeing that that'll be added in specific territories? And can you discuss a little bit about some strengths and weaknesses as far as geographical breakdown, at least domestically here? Thank you.
So I want to take the first half of the question. I'll answer the second.
Yeah. Again, Jeff, thank you for calling and participating in our call. As we said earlier this year, our goal is to increase the U.S. by at least approximately 10 territories. We did it in the first quarter. We are in shape to add about 4 or 5 in the second quarter. We are doing that. I must say, and we said it on the script, that the onboarding, still the pandemic is here, and still travel in Q1 was not that efficient. Onboarding processes took a bit longer, but we are seeing that, and we are onboarding the people, and that's something we've said on the script. So that's from expansion on the domestic front.
Right. From strength geographically in the U.S., we've seen our largest customer, Kaiser, rebounding to pre-COVID levels. Growth is there again. Definitely, if you consider the March weakness last year, this year we see none of that. So really nice growth. We have great, we've seen some of our new territories like Charleston have reached, already, our target of $1 million. This is amazing for us after 4 months. Other areas, traditional areas like Atlanta and others are very strong. New York. So we see very strong demand overall. Our traditional areas of weakness remain, the Northeast Boston area. We have reimbursement challenges there, which have been there traditionally. But other than that, the entire rest of the country, east to west, we have great markets to operate from.
Okay, got it. And then second for me, could you talk about any presentations of note coming from the sleep conference, and then talk a little bit about multi-use and the Spry loop solution, and as far as chronic versus systemic, how should we think about that, and how should the payers and CMS think about that as far as you having or offering a solution which is used periodically or moderately permanently on a short-term basis for patients? Thank you.
Right. So I want to frame the question. Those are, of course, very, very important questions. First is, we as a company, we understand that sleep apnea traditionally is a one-night test because that's how in-lab test works. But it's not how the physiology works, right? The physiology is that things impact your sleep. All of us are exposed to sleep, right? Every person. We know that not all nights are the same. Some nights you sleep better than others for many, many reasons, by the way, not only sleep apnea. And there is a tendency to move from a one-night test, which was traditionally what could happen, to a longer period of testing and monitoring, because that's how life is. And, CMS is not, I don't think they've indicated any recognition of it, but the literature does, and our customer do. So we are moving from one night to offer, as I mentioned, what we call it an enabled multi-night test. So if the first night didn't give the doctors all the answers, they can enable a second night, very easy with Watch But One, just by asking the patient to plug a second probe on the same Watch But One device. It's still very safe, because no exposure between patients, and they can have a second night in which those questions will be answered. But our real vision is to continuously monitor with the patients. We know today very clearly that CPAPs are not being weared in most cases the entire night. Patient remove their masks halfway through the night or 3/4 through the night. So doctors don't have a full picture. Some patients wear mandibular devices. They're becoming very popular now. There is no way to monitor how they're doing, right? All the neuromodulation business that is now, Inspires and others, there are a lot of questions about how effective, stuff like this. So Spry will give the answer. It's not obviously ready today. It's something we're investing in building. and will be available in 2022. But that's kind of, for me, that's directionally where we want to lead the market. Just like the ECG market moved from a single test to 24 hours to continuous monitoring and up to implantable loop recorders. The same for glucose monitoring, from 1 or twice a day into continuous monitoring. We want to make a revolution in test in that direction, and that's what SPRY acquisition will hopefully give us. The progress with SPRY is good. I'm very pleased. We actually visited them last week in person in San Francisco. Shai and myself and the R&D team, we sat a few days with them, not by Zoom, and that was great to see. And we've interacted, we've brainstormed, and we really my confidence in that acquisition is very strong.
Okay, perfect. Thanks for taking the questions.
Thank you, Jeff.
Our next question coming from the line of Ben Haner with Alliance Global Partners. Your line is open.
Good day, gentlemen. Thanks for taking the questions. First off, for me, just kind of following up on the market share gains that you've seen. Can you talk a little bit about who you guys are gaining against? Anything of note on that front?
I don't know that I can name the particular company, but we're definitely gaining from the reusable business. In the beginning, some of it was our own, right? Self-cannibalization. Now we've done self-cannibalizing, and we see the gain coming 100% from other airflow type systems, but it's generally coming from all those reusable airflow-based systems because you have to transfer them from patient to patient to patient, which pose contamination and infection risk. But moreover, those airflow-based systems have tubes that are connected to the nasal cannulas and have air and other body fluids, touching them. And while there is possibility to clean them, it's always a little risky. And single use being the dominant single use, if not the only single use device on the market that is clinically used with sleep doctors, position watch but one is really the only option. So, and that's where we're taking our share from.
Okay, fair enough. And then, secondly, I guess lastly for me, thanks for the color there on SPRY Health, but, I know last quarter you talked a little bit more about identifying opportunities for inorganic growth. Is there anything that we should expect on that front? Any conversations that you've had, or just any additional color that you might have on kind of the M&A activity strategy that you've talked about recently?
Yeah, no, great question. We're constantly evaluating options for inorganic growth. We believe the time is ripe for, accelerating our growth beyond what we can do by adding more reps and territories. There is multiple options we're working on. They are all alongside our strategic initiatives that we're, reporting on a regular basis. Everything from how to generate more patients into the pipeline, and then how to make more revenues once the patient is in the care pathway. And of course, for obvious reason, I cannot name particular names, but we're constantly evaluating good options.
Got it. Well, thanks for taking the questions, gentlemen.
Thank you, Ben.
I'm showing no further questions at this time. I would now like to turn the conference back over to Gilad Klik for any closing remarks.
Thank you very much. I want to thank everybody that joined the call today. I want to thank ITMR employees across the world that are making tremendous effort to continue to support our customers and their patients in those uncertain times. And I want to special thank our Israeli employees that under the really unease circumstances that Israel experienced in the last week have shown great leadership and continue to operate our business as if there is really nothing happened. So I want to thank everybody and appreciate your support.
Ladies and gentlemen, that does conclude our conference for today. Thank you for your participation. You may now disconnect.